Our next guest helps oversee around $17.2 billion of commodity assets under management. He's Nicholas Brooks, Head of Research and Investment at ETF Securities. Good morning. Thanks for joining us. Another record today, Nick. $1,226 an ounce. How far and how fast can it go, gold?
Well, I mean, that's a good question. I mean, we are sort of seeing a perfect storm of events that's driving gold up. In the short term, I think the key driver has been the weakness of the dollar. And strangely enough, in a way, gold is trading like a risk asset these days because of its inverse relationship with the dollar and the tendency for the dollar to weaken when risk assets are running because of investors financing in dollars. But the medium to long-term driver, really, I think, is concerns about growing government debt, not just in the U.S., but in the U.K. and other developed economies, and the very aggressive monetary policies being put in place by a number of central banks. That has led to concerns, one, about sovereign risk and about the outlook for currencies, and also down the line has led to concerns about inflation. So many investors, strategic investors, are buying gold as a hedge against both inflation and currency risks. And
your gold ETF holdings are witness to that, because they've increased sizably since the start of the year, haven't they? Just tell us.
That's absolutely right. I mean, we've seen, we now have about $10 billion under management in gold. We've seen about $2 billion of flows just this year. We see on a weekly basis very, very large flows coming in.
Who are the buyers? Who's the money coming from?
Most of our investors are large institutional investors. They're pension funds and they're private banks as well. But generally, it's the institutional investor that is in our funds.
Is there evidence out there that retail investors are taking advantage of this gold rally?
I think there are. I mean, certainly when you look at the size of some of our purchases in our gold ETCs, certainly there's some smaller purchases, smaller size, so retail's involved. But I think a very strong signal has been the very strong demand for gold coins, gold bars, and I think that that's another sign that retail is also getting involved.
You touched on central banks and their part in what's happening to the global economy, Nick. But what about central banks and the fact that they actually could end up being net buyers of gold after years of being net sellers? That's quite a shift, isn't it?
Absolutely. I mean, that's a very key point that you make there. We saw India move in and take 200 tons of gold from the IMF. That was a surprise to the market. Most people had anticipated that would be China. And we're seeing other central banks trying to diversify away from the U.S. dollar, reduce their holdings of dollars. And one of the key ways to do that, of course, is to buy gold. So whereas for many years we've seen central banks net sellers of gold, starting in the second half of last year, central banks have become net buyers. And that is a massive change in the psychology of the market.
And there's speculation that China could buy either some or all of the remaining reserves of the IMF. But we have had a quote from China's deputy governor, according to Apple Daily. He says the price of gold is very high. The central bank will be wary of investments in bubble assets, Nick. Talk to me about bubbles and gold, because many are saying that maybe gold is in a bubble.
Right. Well, I think, again, defining what a bubble is always difficult. But I think the underlying fundamental factors that are driving gold, including the rise in government debt, the very expansionary monetary policy, indicates to me that there are good, solid, fundamental reasons for gold to be rising. In the short term, you could argue that because of this sort of risk trade that's been on and the inverse relationship between gold and the dollar, that gold could be at risk of a correction in a risk asset correction. But on a medium to longer term basis, until investors feel comfortable with government policies, I think that the medium-term trend for gold is up.
And it looks like, looking at your commodity ETF assets under management as a whole, that the outlook for most, if not all, of the commodity spectrum is a positive one, because it's increased substantially as well, not just gold, but all of the commodities.
That's absolutely right. I mean, we now have about $17 billion under management. At the end of last year, we had just over $6 billion under management, so nearly a tripling of funds under management in commodities, specifically with oil, natural gas, industrial metals, and ags all seeing very, very strong inflows. So I think investors are looking at commodities as a sector to move into, as a hedge against potential future inflation and as a hedge against potential structural U.S. dollar weakness.
Nick, thanks for joining us today. Nick Brooks there, Head of Research and Investment Strategy at ETF Securities. Right.